Welcome, everybody. Good morning, good afternoon. Thank you all for coming. I'm Nick O'Donoghue. I'm the Chief Executive of CDC. CDC, of course, is the UK's development finance institution. So on behalf of CDC, I'd like to welcome you all here to the UK Pavilion to talk about investing for clean and inclusive growth in emerging markets. Let me start by quickly saying a word about CDC, and you will have seen, I think, if you've been watching the video, that our climate strategy has three pillars to it. The first pillar is a commitment to be net zero, and net zero both from a transactional basis and a portfolio basis by 2050. The second pillar is a commitment to adaptation and resilience. We know that the geographies in which we work are the most vulnerable to climate change. And so a commitment to ensuring there is adequate funding available for adaptation and resilience, and also a commitment that the transition to a green economy should be a just transition, and we will talk more about that in the panel. We have made a number of announcements over the last couple of days. We've announced, or previously announced, that 30% of our commitments, our investment commitments, would be climate finance. That translates over the next 5 years into an amount of something over £3 billion of additional funding. All of that £3 billion will be going to Africa and to Asia. We've also announced in the last couple of days that we expect to deliver a new climate innovation facility for the FCDO, which will provide concessionary finance, particularly to encourage innovation and focus on adaptation and resilience. We've made new commitments to forestry, and we were proud in this room actually last night to be one of the founding core partners in the Global Energy Alliance, led by the Rockefeller Foundation and other philanthropy foundations. So it's a lot of specific commitments, we think, backed by real funding. But of course, as a development finance institution, we know that our money is not enough and that we have to work with others. And that's really the purpose of this panel. We want to talk here about how we can really align financial flows with the goals of the Paris Agreements. And for those of us who represent investment institutions, that means how do we change our investment decision-making processes? What can we do to make those changes more quickly and to move capital more quickly? The second thing we want to talk about is what it feels on the ground for those businesses who are really trying to develop solutions to the climate problem, and how we can deliver at scale. So the question of how we can mobilize not just our own money, but across the private sector. And finally, and importantly, we want to talk about a transition that's an inclusive one for poorer countries, an inclusive one for women, an inclusive one for workers, regardless of the sector they work in. So that's broadly where we want to, the issues we want to talk about with this panel. I'm really grateful that we've been joined by four outstanding panelists. We've got, starting on the far right, Bill Winters, who is the Chief Executive of Standard Chartered Bank. We've got Wendy Woods, who's Vice Chairman of BCG and runs the social impact practice. We've got David Auerbach, who's co-founder of Sanergy, based in Kenya as a CDC investee. And we've got Dola Kabanda, who is the former Chief Executive of Africa Risk Capacity Insurance. He's an NED in various public and private organizations, including, I'm pleased to say, an NED of CDC. So thanks to all of you for coming. I wanted to start, if I can, with Bill. Bill, Standard Chartered Bank, CDC Bank, very different institutions, but basically similar markets, similar footprints. I suppose a similar dilemma, and the dilemma is really how can we change the way we make investment decisions to reflect the climate emergency we're in. And so to Standard Chartered, I suppose, what are you doing differently in terms of how you're making investments?
Yeah, I think, like CDC, probably not too big a change because we've always been there. That's we started in Africa in 1858 and have never left. So we've been through the ups and downs. What's different this time around is that the need for financing is much larger, and it's much more specific. So the requirements for transition finance, which when we look at across the continent of Africa, the sort of visibility on the financing gap of maybe 10% of the money, 90% we have no idea where it's going to come from. If you looked in Europe, you probably 70%, you have a pretty good idea where it's going to come from. It doesn't mean that it's there or that it will be easy, but the pools of money are in place, the projects that will be financed are understood, the level of government backing is there. In sub-Saharan Africa, it's much closer to zero. But the needs are very, very great. It's also the area, Sub-Saharan Africa, South Asia, are the areas where you can have the biggest impact, right? A marginal dollar invested into a transition project in Sri Lanka or in Ghana is probably 7 to 10 times the carbon impact of the marginal dollar in Holland or Germany or the UK. So from a societal perspective, we actually have to get this right. I mean, we Standard Chartered are there. The way that we've tried to approach this is the way I think we always have, which is just understanding very well what the gap is, what the needs are. There's always an element of education. So in order for our clients to access financing, not just from us, but obviously from you and from the capital markets more broadly, from multilateral development banks, because the only way forward is for key projects is a blended finance approach. We got to start with the data. We've got to start with some standards that capital markets investors in particular can get their arms around and understand. And then we need to repeat those standardized products again and again and again so that we can institutionalize this asset class of sustainable finance. If we can institutionalize it, then we can unlock the trillions of dollars of ESG-related funds that are earmarked for these kinds of projects but have no ability to get into a complicated project in South Asia or Sub-Saharan Africa. And we see that over and over again, hence the very low proportion, or low level of visibility. So I guess we could say it's the same as always, and it's completely new. And I guess it would be the same for CDC.
Yeah, right. So Wendy, you work every day with private companies, work every day with the public sector. You talk to them about how they're rethinking their business. You talk to them about how they're working together. How are you seeing the clients that you serve really change in how they're approaching emerging markets? And do you think they're changing fast enough? Do you think they're making really the difficult decisions that need to be made?
So I'm going to bifurcate my answer a little bit for you. And part of me says absolutely yes. There has been tremendous change just in the last several years, especially when we're talking about aspects related to mitigation. And it's smart. It's the only way to do business right now. I mean, we look at the analysis, and companies in heavy emitting industries that are lower carbon emission than their peers, than their competitors, actually see 20 percentage point premiums on their valuations. So for businesses that are in the mitigation side of our world, we're seeing tremendous change. It's self-interested, it's smart, and it's happening fast because the incentives are aligning for that to happen. Where I worry more, and I think we've got to really work on picking up the pace, is everything related to the adaptation side of things. And the movements are happening there. But when we start to think about what it really means in Africa to actually get extensive regenerative agriculture, when we start to think about the things that are really going to drive growth in that economy and actually especially allow in some of the most affected places in the world to be able to respond, I think that's where transition is happening a little bit slower. And we're not seeing the incentives line up nearly as strongly or nearly as quickly. And I think that is where we need the public-private partnership around things to continue to accelerate the pace.
Yeah, great. Thanks, Wendy. So, David, thank you for being here. Congratulations, first of all. For those of you who don't know, Sanergy was one of the 15 global nominations for the Earthshot Prize. Didn't win, sadly, but we still, as a CDC investee, we're very proud to be associated with the company. I guess it's probably less well known than Standard Chartered and BCG. So maybe why don't you start by telling us a little bit about your story, what you do, what your ambitions are.
Great, sure. We feel like we won, just to be clear. My name is David Auerbach. I'm one of the co-founders of Sanergy, based in Nairobi, Kenya, where I've lived for the last 10 years. And what we do is take a circular economy approach to solve the sanitation and waste, organic waste challenges in fast-growing cities. And what we do is collect lots and lots of waste, and from everywhere from public markets to agribusiness to a whole network of sanitation facilities that we've built, waterless sanitation facilities that serve about 150,000 people in low-income areas. And then we convert that waste at what is now the largest organics recycling plant in East Africa into regenerative agricultural inputs. So it starts with these guys. These are called black soldier fly larvae. These are big business in Europe right now. There are companies that are getting unicorn valuations for what they're doing. We do this in Kenya and are doing this competitively with what is being done here in Europe. And what's really important is that these larvae, they eat organic matter. It all disappears. They get big and fat. We harvest them, boil and dry them. End product, 40% protein, perfect for livestock, chickens, fish, pork. You know, there's huge dependencies on fish. There's huge dependencies on soy for animal feeds. But actually, you know, this is what goes into free-range chickens, right? This is what chickens eat anyway. So we produce that, compost it. They leave a residue, compost it. We convert it into organic fertilizer. There's almost very little formal organic fertilizer production across Africa, in Kenya, and so we're able to produce it. We produce about 600 tons a month now, which we sell mostly to horticulture, and then get it to the right standard also for EcoCert certification for export farms too. And this is increasing farmers' crop yields by about 30%, serving about 5,000 farmers through a network of 500 agri-vets, so creating lots of jobs in the process too.
Great, and I have to say, every time a politician goes to visit Kenya, or every time a sort of a business leader goes to visit Kenya, and they want to visit a company that's having doing something really innovative and having a real impact, they end up, it seems to be, visiting Sanergy and coming home and taking pictures and waxing lyrical about it. So I know, David, that you get a lot of visitors coming and touring your facilities, but that's not really what you need. What you need is money, and you need support from the financial sector. So how difficult is it to scale up a business like yours?
Yeah, no, sure. I think the example I just gave at the beginning about how we're being compared against European companies, for example, much easier to attract capital on those types of for them. For us, you know, we've done a good job, but it's a lot of innovation capital, right? I would say, you know, you call it like quite early stage. We're fortunate to be invested in by CDC, which is a LP in a fund called Novastar, and Novastar's, you know, raised approximately $100 million funds. They've led us through our Series A, Series B. Now we're moving into the Series C, where, you know, we need to be able to attract about $100 million, 20 million equity, 80 million debt. We're bringing in some like really exciting investors. JICA, the Japanese government, came in just like about a month ago, which is exciting. But it is the most arduous diligence processes right now. It takes all of my time and half of my co-founders' time. And this is something that, you know, we think can be solved. You know, like a very simple example. Actually, you mentioned ESG. You know, hey, thank you.
Bill wants to come and visit you next time.
Well, we actually bank with Standard Charter, and nobody knew that coming into this. I promise, though. And it's actually very responsive to our needs. But more supply chain financing. Yeah, that would be really quite helpful. Thank you. Where was I? Sorry. Yeah, I got lost there. No. So something like ESG. You know, right now, every single investment fund has to go through their own exact same ones. Even though, like, we've gone through, you know, OPEX, we've gone through the Japanese government, we've gone through fin funds. Each of those things takes 3-6 months often. It takes complete, you know, and so how can there be trust and collaboration among these funders on things that are probably not completely confidential, for example. So.
Thanks, David. So, Dolika, let me turn to you. So much experience in Africa, so much experience, particularly with Africa risk capacity and thinking about the risks that African companies and countries face. So, tell us firsthand what you see, what impact climate change is having, and talk specifically about those risks that exist in Africa and why you think action now is so important.
Thank you so much, Nick. Look, I think I always approach this subject matter from the three P's that we all know, which is people, planet, and partnerships. And I find that sometimes when we're sitting in rooms and organizations such as this, we're very focused on the partnerships and on the bigger issues and on the MOUs that we sign. And we forget that the underlying reason why we are all here is about people. The impact of everything that we do and don't do and have not done since COP1 is impacting people. And these people are largely, they are global, but they are largely in the developing countries and are least able to cope. So if we say we've given, and those populations are going to double by 2050. So whatever solutions we're putting in place now for 2030, we must be very aware that by 2025, 2028, they will already be under a lot of stress and strain. So from just the impact perspective, a lot has been happening. As we know within CDC, you just described, David just described Sanergy. Sorry, David, I don't have a business card nor a check to give you, but I'll be your biggest champion. The difficulty of the real game changers and the real end beneficiaries actually accessing that $100 billion that we've been talking about is real. It's real. And I think we have to recognize that because that gap is real and money is not getting to the end beneficiaries or the end game changers, we are actually running a risk. From a risk management perspective, whether you're in the finance sector, you're in infrastructure, you're in medicals, we invest so much upfront to get those structures up and running. We do railways, we do ports, we do airports, we do agricultural farms, but we do very little on protecting ourselves from the downside that can happen against those investments. So a tropical cyclone emanating from the Indian Ocean islands will run all the way through into Zambia, Malawi, which was never the case even 5 years ago. We feel the impact, and feeling the impact means women giving birth in unsanitary conditions, taking their daughters out of school, being exposed to gender-based violence, and never being able to get back into mainstream. So the chasm gets bigger and bigger as long as it takes us to try and close and find solutions that are workable. So the end impact, I think we should never forget as we have these conversations, is on real people. Ask a child, I saw a poster out there, ask a woman. London is now seeing floods, but the impact on a woman in London is very different than the impact on a woman in India or in Africa. And those populations are the ones that are getting boats, they're migrating, some are drowning, but some are ending up in these very cities and straining these infrastructures. So I think the impact is real, but the good things that we're doing. So if it's a 5 million for Nova Star, Bill, let's make it 500 million. That's what we need to do now. We're not going to, it's a deal. I'm just emphasizing it. But we've got to scale this up. We've got to act urgently, we've got to scale it up, and we can. We can. The creativity of financial institutions in partnership with everybody else has already been able to achieve some amazing things. We just need to scale it up. And it's not an asset class, Bill. It's an investment, pure and simple. Giving it a categorization in itself is something that makes it stand outside of the mainstream. This is mainstream. This is our business.
Thanks, Dolak. As always, Dolak always manages to capture exactly what the issues really are, what the issues really are on the ground. But it's a fantastic segue, what she said, to the next question I want to really ask everybody in this panel, which is around this question of a just transition. And how do we make sure that this transition is fair? It's fair from a gender perspective. It's fair and inclusive from a jobs perspective. It's a term that's used a lot and sometimes rather loosely and without clear definition. So, Bill, let me start with you. What does just transition mean to you, and how can we ensure that the transition to a greener economy is an inclusive one?
It's been a huge question for us. We actually published our quite detailed net zero transition plan last week. So you will not have had a chance to read it, but it is very detailed, and probably the most actively debated matter was how we define a just transition, and how we, given where Standard Chartered operates across Asia, Africa, the Middle East, the bulk of our activity is in those markets. We know that there are big swathes which are well below the global median in terms of disposable income, high levels of people without access to banking or power, and the idea that and of course they haven't been the big contributors to carbon emissions through time. So there's a fairness question, but more immediately relevantly, there's a question of justice and what a just transition is. So we've taken the view that we need to continue to be able to support the economic development in the markets where we operate. That element of justice means that our net zero pathway will be different than somebody who's operating exclusively in a developed country. In particular, in some of our markets, we'll actually have an increase in emissions in the very short term, typically as countries migrate from coal to gas, and then from gas to renewables over time. If we can get there in one jump, fantastic, but it's not always that straightforward, especially in economies that are still growing and where the level of poverty is quite high. So we will get to net zero, we'll hit our 2030 targets, we will make up in some markets where we are effectively investing in others in terms of emissions, and we'll continue to appropriately, we think, balance economic growth in the markets where we operate with a focus on inclusion and alleviating poverty versus the net zero pathway that we've set out in aggregate.
Great, thanks, Bill. I should have said at the beginning, Bill unfortunately is going to have to leave us a little early. Hopefully I'll get back to you with another question before you leave. Wendy, just transition.
Sure. So the tragedy of COVID, I think, taught many of us one thing, which is none of us are safe until all of us are safe. And I think the same obviously applies for climate, and none of us are going to solve climate alone until all of us have solved climate. I think the part that we sometimes forget is we will have to buffer ourselves, we will have to buffer very broadly to actually adapt and adjust and compensate for what is already happening as it relates to climate. And that we need to do for all too. I think one of the things I want to point out very specifically is as it relates to the gender point you raised, Nick. And we just did some work. And what I am most worried about right now as it relates to the gender dimensions is that we all know that climate is hitting women and vulnerable populations more, the climate change. What I'm worried about is our actions to protect against climate change may actually exacerbate the disparities that we're seeing on gender. Because if you look at green venture, green tech innovations and startups, the proportion of funding going to women versus men is even worse for green investments than it is in the normal venture investment space. When you look at the reskilling that's happening to get people up to speed and who can actually engage and support our green industries going forward with that reskilling is coming from a lot of heavy industries that are 15 to maximum 30% women. So women are missing out on the reskilling opportunities. So what we really need to do is actually take a gender lens, take a lens of those populations that are disadvantaged and say, how do we make sure the actions that we are taking to protect the planet don't actually exacerbate the problems that we've got for the most disadvantaged to begin with.
Great. Thanks, Wendy. David?
Yeah, great. Well, I mean, first of all, I think the easiest is, don't pay lip service to your values, right, as a company. I think that really is where it starts. For us, on the energy side, the factory that we've just built, we put in solar panels, and then we also produce briquettes too. So it's actually over 90% is done by energy generated at our own factory itself. And it's we've been able to prove that we are the carbon offsets are significant. On the gender side, we've been investing heavily on this. I think something I like to think about what we especially are doing with organic fertilizer. Making sure that we are hiring sales agents, female sales agents, so that who are more effective at being able to sell to female farmers. And of course, there's many female farmers too. But that's you have to do that very purposefully. And so much of the infrastructure around sales and distribution of fertilizer has been done by men before. And so so just being willing to change it up is really important. And then third, I would just say on sort of what company we're building. We have about 500 on staff. We have 97% are Kenyan, 27%, 67% are under 27 years old. For our leadership team, I mean, we spend enormous amounts of resources developing our leadership team at junior managers, middle level managers, and senior managers because we want to go global. We want our Kenyan operations to be run fully by Kenyans, and as we do this and building a company in that way, we think is the only way to succeed.
Okay, thanks. Dolika?
For me, just transition brings three words to my mind. One is equitable, not equity, but equitable. The second is the partnerships. And the third is the resilience piece. Whatever we do as we talk about climate interventions, adaptation, mitigation, the end game is to assure resilience by or for all in a fair manner. On the partnerships, we cannot do this as private sector alone. We cannot do this as public sector alone. And so for me, the ability to be able to mobilize, was the word you used, Nick, becomes critical in terms of reaching the numbers that we need to put together in order to be able to address the problem that we have today, a problem that continues to grow rather than abates. And then on my first point, which is the equitable approach, is that we've heard it here, we've heard it before today, that the developing countries complain that we didn't bring this problem about, and therefore why should you punish us at the expense of our own development? And the developed world has a counter answer to that. That's not what the discussion is. The discussion is we are on a boat in the high seas that is sinking, and if the bosun and the captain are arguing about whose fault it is and how we got here, we're all going to drown. So for me, a just transition carries those three principles: equitable, partnerships, and the end game, which is resilience for all, by all.
Great. Thanks, Dolika. Okay, so Bill, I know you have to go in a minute. I just did want to ask you one question before you go, because you are the chairman of the Task Force on Scaling Voluntary Carbon Markets. And I suppose when we look at ways to perhaps incentivize biodiversity, forestry, and so on in Africa, carbon markets and carbon credits, for many people, believe they have a role to play, but I know at the same time they're controversial. So give us your views on where the task force is and what role do carbon markets play in our future.
Yeah, thanks for asking that. I think they are controversial, and they're controversial because since these markets were created 20, 30 years ago, there's been no consistent standard. And the carbon credits that have been originated, some have been really super legitimate projects that have actually reduced carbon in the environment, and others have been much less rigorous that way. Unfortunately, the less rigorous have dragged down the reputation of the whole set of instruments. So the task force that we set up over a year ago, with 450 members, 250 organizations representing civil society, NGOs, academics, as well as the polluters and investors and others. So the whole carbon value chain said, let's set a consistent, very high integrity standard that we can all agree on, and then let's put a governance framework around it so that it operates on its own, a self-governing, high quality, high standard organization. The task force, which I chaired, made its final recommendations in July. The key recommendation, key recommendations, one were what the standard should be, and there's 180 pages of that, reasonably granular, but not 100% done. And then we set up a board, and the board is structurally independent, populated by people that don't have an economic interest in the carbon market. That board was stood up about a month ago. It's I'm an advisor, but I'm done with the formal governance. And as it should be, because the people who are running that board now are two co-chairs who are independent experts in this space. And they will finalize, they'll take the recommendations that the task force made and put those into a rule book, a set of standards that I think the vast majority of expert observers would say, yep, this is super high quality. There's no question that these are good credits. This is actually removing. If we get it right, then we're talking about, initially a few $1 billion a year. I think very quickly we get to tens or possibly hundreds of billions of dollars a year, going overwhelmingly to the developing world, initially overwhelmingly into nature-based solutions in the developing world. Over time, I hope, into more technology-based solutions as well as the market scales up. So it's an opportunity to shift funds to where we can have the biggest impact. It's also an opportunity to set an understandable and transparent price for carbon. Once there's a real price for carbon, which we don't have today, it fundamentally influences corporate and public sector decision making. So I think it can be transformational. Quite a bit of heavy lifting to do from here.
Yeah.
Nick, I'm sorry to have to leave it. I
No,
really
thank you.
enjoyed
Well,
listening to the other
yeah.
panelists. I'm sorry
Yeah.
to
Thank
leave
you.
early.
Thanks, Bill, for coming. Thank you. Okay. So let's get back to capital and mobilizing what needs to be vast amounts of capital. Wendy, how do we really persuade the private sector or incentivize the private sector to really dedicate the amount of capital that this transition is going to need? And particularly, how do we make sure it goes to the difficult
The places that
yeah.
need it.
Yeah.
Well, I think the good news part of this is that the private sector is already incented. And what we have seen this week and recently is literally trillions of dollars being committed to green investments, inclusive investments, the kind of investment that we actually want to see. What we're struggling is to find the places to put that capital that has been committed to work. And what we're missing, and we've heard some of this already, but we're missing the projects that are actually at scale. When you're looking to put millions or trillions of dollars to work, you need projects of a certain scale. Right now, we're having a hard time finding those in the places that actually need them the most. And so one of the things we need to figure out is how do we get that scale of the projects? Some of the things that are happening are efforts to aggregate projects. So one example we've worked with is WWF. How do you actually aggregate bankable projects to a size that you're going to interest large banks, large investors that actually have to put large sums to work and don't actually have the capacity to do it at micro levels? And so aggregating things, COP22, adaptation for African agriculture, aggregated a whole bunch of projects that would allow adaptation in agriculture. Individually, they might not have captured the attention of big investors. Together, they can. They're actually at sufficient scale. So how do we actually grow projects of a scale that will be interesting and or aggregate projects so that they're actually investable for those large, certainly institutional investors, but even large private sector investments? That's, I think, part one. You've also heard a lot, and I actually think of this as a huge sign of progress, but I've heard a lot at this COP about words like data and information and standards. I actually think that's progress, because what people are saying is we need to find consistent ways to compare. Investors need trust in their investments. They need to know that the data they're seeing is giving them a reasonable read so that some sort of return is going to be there. And the information systems that create standards that are comparable across opportunities, that actually provide enough insight, enough transparency so that investors actually know what they're getting into. I actually think the incentives are there, the finance is there, and the question is how do we create the scale and how do we create the consistent information systems? You heard Bill talk a lot about standards for the carbon markets. We need standards across all the way we look at ESG and allow the comparison that is going to allow investors to have confidence in the investments that they're making at scale. There's a lot we can do. Just one more quick example. I don't know who knows the Sustainable Markets Initiative. Prince Charles has been pushing that with, I think, the latest count, and I'm sure it's growing, 300 CEOs. And it's all about how you scale private sector investments in these markets. And it's actually putting open source tools in place to allow those that are seeking the investment to actually communicate, potentially group, and scale. So it's all about that development of the business case and the projects that will be investable.
Thanks, Wendy. So, David, I mean, you come here to COP, you hear all these big numbers, billions and tens of billions and hundreds of billions thrown around, and people talking about mobilization and so on. You're sitting there at the sharp end with a company trying to do another round of financing. Wendy makes the point that it's really, there seems to be a lot of money around, but if you go to the really difficult, the really risky end, it's hard to raise capital. Is that a fair reflection? And what should we as an investment community be doing to change that?
Yeah, no, I mean, I think that that's my exact response. Like, it certainly doesn't feel like it's all there, and I think that, I think that there needs to be, for us, what we see is a very a very high level of distrust about what's happening on the ground, ultimately. And I think it's a much higher level of scrutiny than what you are seeing in developed markets, very simply. And I don't think it's just on the onus of the companies to be able to have to prove that they're big enough or that they're worthy enough of the capital. There has to be mindset change. There has to be people. I mean, even the investment community, you were joking about it, but it's serious. When they come down and see things on the ground, it's very different, and like it's the aha, of what's going on. And when you take about like how investors think and how they how they work to de-risk, right? Africa still gets heavily discounted for political insecurity, right? It still gets heavily discounted for currency risk, like all of these things, and some of it's valid, of course, but like at the same time, going in with the mindset that we have to make these deals, I think will actually change how the investment community reacts to this. And instead, it's always how do we say no is really the bigger challenge or the more typical mindset that we see.
Okay. Okay, Dolika, we're almost out of time, believe it or not. So I wanted to give you this last word on mobilization, raising capital. You've been with the IFC, you've worked with CDC, you've worked in the insurance. How do we mobilize more capital? And is that the real challenge?
I think it is a real challenge because I sit on both sides. I sit on the side where this capital is available and is announced as being available. But I also sit on the other side with David, where you see some really good innovation trying to access these funds to make it happen. So I think we just have to keep pushing. Nick, I don't want to say people haven't been working on this, but there's an urgency to it, and there's a scale issue to it. And part of that for me is a great role for the DFIs, which is that they have always been on the frontier of going into territories that others have not gone into to demonstrate that these things are viable. So I think we've got to keep pushing that envelope with a much higher sense of urgency than we've had up until now.
Thanks, Dolika. Look, I agree. I will also add to that risk appetite. I really think we talk about tens and hundreds of billions of dollars, but when you really drill into where that money is going, it's very often just going to find low risk, easy to do transactions in easier countries. And people like David in tough countries with trying to build transformational businesses find themselves still starved of capital. And so we need to move the risk needle. We need to do it in the development finance community. And we've been very fortunate at CDC to have a catalyst, what we call a catalyst portfolio, that allows us to take additional risk in pursuit of enhanced impact. But we all need to turn the risk dial a little bit. And commercial investors cannot expect just to get a subsidy that allows them to take all the risk out of a transaction if they really want to live up to their words of committing larger amounts of capital. So look, I'm going to stop it here because we're going to have a video and then the minister is going to say a few words. So I want to thank you. Thank you, Dolika. Thank you, David. Thank you, Wendy. That was great. Great to have you here. Thank you. Thank you. So I think we are now going to show a short video. I hope.
Mitigating climate change is really at the core of what we do at Mkupa. While we're a financing company, we see financing for consumers as a critical enabler for allowing customers to switch from potentially harmful uses of energy to more renewable ones. We have done this historically with our solar home systems and look forward to doing it with other kinds of devices like electric motorbikes or electric cars. So really we see financing for consumers as an important enabler in allowing consumers globally to move from harmful power sources or not energy efficient appliances to more renewable energy sources.
India, you would typically pay about 30 to 40 cents for a cubic meter of water. And they end up paying something like $7-8 at peak demand, because that's when the water scarcity at its highest. And most of the times, what happens is that they're tapping the water which is actually meant for agriculture or potable use for people. So that's a double-edged sword, because you're not only depleting or paying a very high price, but you're also tapping into the water that was actually meant for human consumption or for agriculture.
Okay, thank you. So it's a couple of very good examples there of CDC investee companies that are making a real difference in this question of development and clean and green transition. At this point, I wanted to introduce Minister Helen Whately. Helen was appointed Exchequer Secretary in 2021. She was previously a Minister in Social Care and in DCMS. In the Exchequer, she's responsible for areas including energy infrastructure, environmental taxes, digital and small business policy. So a lot that overlaps with actually the themes of this COP26. So Helen, it's a great pleasure to welcome you here, and the floor is yours.
Thank you, Nick. Thank you very much for that introduction. And it's been great to be here just for this fascinating conversation amongst the panel. Really, really good to hear from such a range of viewpoints, including the global and financial perspective we got from Bill Winters of Standard Chartered and from Wendy Wood of BCG. I found it really interesting hearing them talking about how the capital is there, like the finance is there, but the challenge of getting it to where it needs to, the challenge of getting projects to be at the scale they need to, whether it's through aggregating, achieving a scale so that they're investable, and the importance of standards and consistent information to give investors the confidence they need. Like, these are all just so timely to be having that viewpoint in this conversation, and to connect to some of the announcements that the Chancellor made earlier today. It was great hearing you, David, from Sanergy, as you're a company like right on the ground, trying to do it. So it's very different from the sort of global perspective. To there you are in Kenya, trying to make a difference to people's lives, but like facing some of the practical challenges, and particularly the practical challenge of securing financing. How difficult and incredibly time-consuming that is for you as a business. And then I loved hearing from you, Donica, bringing your perspective. And you spoke so powerfully, I'm sure others here will agree, about the people dimension. You so brought that to life, when so much we talk about is the theory of how we do this, but what this actually means for people on the ground, how people are affected. We talk about mothers giving birth, daughters being taken out of school, and reminding us what climate change really means. And those we may have flooding here in the UK. The impacts are felt so much harder, particularly in developing countries with less resilience. And also along those lines, Wendy, you highlighted your concern that actually some actions that are being taken might actually exacerbate the gender disparity. And I just briefly want to say on that point, on the importance of a just and inclusive transition, where we know how the fact that women are more likely to bear the brunt of climate change, and how it's vital that women and marginalised groups get to share the economic growth actually generated by the actions that we need to take, and benefit from the jobs and opportunities. And also that an inclusive investment approach is actually not only the right thing to do, but also really smart. Because I say, as we face the huge threat and the reality of climate change, we need to draw on everyone's efforts and ideas, whoever they are, whatever part of society they're from. And I'd say, on the one hand, we are making progress. But we all know, and we're all here at COP because we know there is absolutely no way that, or no time for complacency. One thing I want to say, just coming to CDC, is that I welcome CDC's commitment to dedicate 30% of its new investments over the next 5 years to climate finance, to supporting developing countries to adapt to climate change and achieve their net zero goals while strengthening their economies. And it's the government's hope that the increased focus from CDC and other development finance institutions on climate finance will catalyse further private sector investment. The UK government is also very much focused on creating the right conditions for private-public sector partnerships to flourish. We have just committed 200 million to fund a new climate innovation facility to allow CDC to start and scale higher risk, as you mentioned, Nick, moving the risk needle higher risk, higher impact investments, and to encourage other DFIs and private investors to then join in. However, as we've heard throughout this conference, helping developing countries adapt and prepare for climate change is going to cost enormous sums of money, potentially as much as 300 billion a year by 2030. So while our new climate innovation facility is an important step forward, we know we need to do more to mobilise the private sector capital needed to mitigate and tackle the effects of climate change and drive sustainable, resilient and inclusive growth. That is the challenge at the heart of this Finance Day, and I urge all of us here to continue striving to meet it. Just coming back to something you said, Dolika, which was your brilliant boat example, in which you said that no, we shouldn't be arguing about whose fault it is, just get on with it. I would say that's absolutely what this COP Finance Day is about, is getting on with it and making it happen. And I'm delighted to be part of this event, which is talking about how we do that. Thank you, Nick.
So that's all we've got time for today. So I just wanted to thank you all. Thank particularly again our panelists for coming. Thank the Minister for being here. Thank all of you for being here. Look, we know at CDC we're extraordinarily privileged to have the support of Her Majesty's government in the way that we have it. But we also recognise with that privilege comes enormous responsibility. And there is no issue that's more important for any of us, and particularly for the people that live in the geographies in which we invest, than climate change over the coming decades. So our pledge is to do whatever we possibly can, both with our own funding and by mobilising others' funding, to really change, ensure that any transition is a just one, ensure that we take account of the need to provide adaptation and resilience, and hopefully change in a meaningful way the lives of the people that live in the geographies in which we serve. So thank you all again for coming. It's a pleasure to see you all.